Welcome back to another weekly episode, guys. So today's episode begins as a tribute to William O'Neill, who passed away this week. He was the greatest stock market educator that anybody knows in the world of stock market, who believed to share the knowledge he had. See, there are a lot of people who become great traders and investors, but I think less than 1% of them are willing to share their knowledge or pass on that information to the next generation. And I think William O'Neill will be remembered as the greatest stock market trader and investor who actually believed in sharing information with the next generation and the many generations to follow. He has obviously had a tremendous amount of impact on my life, and I'll highlight 5 of his rules that have really helped me become a successful full-time trader and investor in the market. So there are about 12 rules, broad rules that he has given. I'll just pick out 5 of those which have had the most impact in my life. And obviously I'll link that with the current market context so that you can see how these things work really well even now. So the first rule that he teaches is about stubbornly holding on to your losses when they are very small and reasonable. Most investors could get out cheaply, but because they are human, their emotions take over. You don't want to take a loss, so you wait and you hope until your loss gets so large that it costs you dearly. So what technically he's saying here is that at any given point in time when you enter a trade and the trade is not working out in your favor, you have the option to cut out that position and to get out at bare minimum loss that'll cost your account. But what happens is a typical investor, being a human being, gets into the mindset of hoping rather than seeing the truth on the screen, and he continues to hold that loss-making position that eventually gets really big for his account. This is by far the greatest mistake nearly all investors make. They don't understand that all common stocks are speculative and can involve large risk. So you got to understand that being a good company and being a good stock are two different things. A company can be really good, but if the price is not heading higher, then you got to be proactive as a trader mainly. As an investor, yes, you can hold on to some of the stocks that you really like for a long period of time. You don't want to sell out, maybe they pay out dividends, those kind of things. But especially in longer form of trading, you got to remember, do not confuse or do not get mixed up between the concept of a good company and a good stock. A company can be good, but the stock has to be good, because ultimately, if the stock moves higher, it is only then that you make money in the market. So I'll just give you a couple of recent examples of mine. Last week I did a video about cutting out your positions at a specific number, let's say 7 to 8%. I'll link that video up here just in case you missed that. So what I do is a little bit different. Yes, I have a ballpark number of 7 to 10% where I like to cut out positions. But the way I buy stocks, usually my buy price, or that is the buy candle where I buy a particular stock, the low of that candle is generally not violated. And that is why I have my own rule to protect my account in terms of loss-making trades. So let's say this is a beautiful VCP volatility contraction pattern, and I get a breakout and I buy here. So what I generally do is, can you see this wide range candle, the low of this candle? In 9 out of 10 trades of mine that go on to become successful, this low point is never violated. So the way I improvise in my own account is that, let's say I buy a stock and the stock keeps heading higher. The moment it moves lower than the low of this buy candle, I have a serious review about cutting 50% positions there and there out. See, when I enter the trade here, my stop loss is actually this particular point. But it is my own rule, and based on my historical analysis of my trades that I do, that most of my trades do not violate this particular low point. So as soon as it does, I cut out 50% position, and then I patiently wait for this particular stop loss to be taken out. There will be times when stock will gap down, hit the stop loss, that is the 50% stop loss, it will consolidate here and again head higher. That is fine. I'm not bothered about stocks that are making profit. I'm not bothered about stocks that eventually move down, hit my trailing stop loss and move up again. I'm only bothered about one thing, that I don't want to lose too much money when I'm going wrong. I can take smaller losses, I can reassess the market I can reassess the patterns that I'm getting into, and I can make a lot of adjustments if my risk management is really tight. But if I start getting too complacent here, the stock is moving up, I'm buying here, it gaps down, and I don't do anything to further protect myself from what can happen. A stock that is gapping down 4, 5, 6% can consolidate for 2-3 days and again gap down 4, 5, 6%. That is the nature of gaps, and that is why gaps are so tricky to trade in the market. So this is one of the teachings of William O'Neill I've taken, and I have sort of customized it based on how I buy stocks. The second rule that he teaches is about not having specific market rules to tell you when a correction in the market is beginning or when a market decline is most likely over and a new uptrend is going to start. It's critical that you recognize market tops and major bottoms if you want to protect your account from excessive give back of profits and significant losses. You must also know when the storm is over and when the market itself tells you to buy back and raise your market commitments. You can't go by your personal opinions, news, or your feelings. You must have precise rules and follow them. People wrongly think you can't time the market. See, you can time the market. Timing the market is not that difficult if you follow basic things in technical analysis. One of the rules that I follow is price with respect to 50-day moving average. This is a daily time frame chart. This is of Nifty Bank. Now, this does not mean that price, when it violates 50 DMA, I'm going ahead and exiting everything and going ahead and short selling. No, that is not true. But can you see these phases? And can you see this phase? Because I think most of you were here when this was playing out. Can you see what I did here? No aggressive bets in the market. I used to simply, continue systematically investing, systematically trading, no big bets in the market, no major positions in the market. But as soon as market stabilizes, moves above the pivot, starts sustaining above 50 DMA, this is where I build positions and portfolio aggressively in the market. So for me, when William O'Neill writes about people not having general rules about when the market is under correction or when the market is bottoming out and those kind of things, I have simplified these things, taking into account 2 data points that I track the most. Number 1 is 50 DMA and number 2 is 200 DMA. 200 DMA is something that I use for really long-term investments. 50 DMA is something that I use as a positional trader in the market also. That is a long-term trader in the market. The third rule is selecting second-rate stocks because of dividends or low price earning ratio. Dividends and P ratios aren't anywhere near as important as the earnings per share growth. In many cases, the more a company pays in dividends, the weaker it may be. It may have to pay high interest rates to replenish the funds it is paying out in the form of dividends. Better performing companies typically will not pay dividends. Instead, they will reinvest their capital in research and development or other corporate improvements. Also, keep in mind that you can lose the amount of dividend in 1 or 2 days fluctuation in the price of the stock. As for P ratio, a low P ratio is probably low because the company's past record is inferior. Most stocks sell for what they are worth at any particular time. Now, see, I'm also a big believer of buying stocks where the growth is visible and where even P ratio is on the higher side. I'll just give you one example. Now, this is the list of stocks that I picked up from the first week of March. I've discussed all of these names with you also in the March videos. Look at my average P ratio here. 115, 80, 78, 70, 63, 63, 63.12, 60, 53, 38, 37, 36, 35, 34, 33. This I'm giving you average P ratio for my top 25 holdings. All right, what do you see here? Average P ratio for Nifty today, I think, is 21. Even my the stock where I hold the least amount of shares, or in terms of the money I've invested, the P ratio of that is also 24. You look at price of sales, price to sales. A price to sales ratio, if you go by what is taught in the books, it is written you should never buy a stock that has a price to sales ratio of greater than maybe 2 or 2.5. Look at my stocks: 5.67, 6.13, 8.84, 21, 6, 3, 9, 7, 7, 2, That is almost 3, 6, 6, 2.8, 4, 6, 5. Are you getting what I do? Also look at the price to book ratio: 23, 8, 18, 8, 9, 9, 8, 5, 5, 7, 11, 4, 6, 7, 9. This is 1.74, 3.47, and so on and so forth. More importantly, look at the sectors: consumer cyclicals, basic materials, technology, industrials, healthcare, defensive, technology, basic materials, industrial, consumer cyclicals. Most of these sectors actually have stocks that are high PE stocks, because those stocks are doing exceptionally well in the market and the market rates them at that particular level. Yes, don't be blind about it. So let's say I'm holding a P ratio stock that is 100, 110 P ratio, and tomorrow the price starts forming a lower high, lower low structure on daily time frame chart. I will obviously adjust my positions. I won't be blind about it, but that is not to say that a high P ratio or a high price to sales ratio or a high price to book ratio stock is not worth it. That is completely wrong. In fact, some of the biggest winners in the stock market are stocks that are richly priced in terms of price to earnings. So this was third rule of William O'Neill that actually helped me out a lot, because whichever traditional books you used to read, there was one message about what kind of stocks you should be buying, and generally you will read, especially in value investing and those kind of things, that the P ratio should be somewhere between 8 to 12, 8 to 14, and for a long period of time actually I followed that advice. Then I started looking at high growth stocks that have really high P ratio, good PEG ratio, price to sales clearly above 3, 4. That is when you start catching really strong stocks in the market. And today my average P of the top holdings that I have is somewhere in the 40s, exactly double of the benchmark index Nifty. So don't shut out or stop looking for stocks that are highly priced in the market. Of course, don't be blind about it, but be open, have an open mind. If the stocks are again setting up well and breaking out, then you should be going behind those stocks. The fourth rule that he teaches is not learning to use charts and being afraid to buy stocks going into new high ground of sound chart basis. The public generally thinks a stock making a new high price seems too high, but personal feelings and opinions are emotional and far less accurate than the market. The best time to buy a stock during any bull market is when the stock initially emerges from a price consolidation or sound basing of at least 7 to 8 weeks. Get over the normal human desire of wanting to buy something cheap on the way down. Now, this single biggest piece of advice I can tell you has done wonders for me. I've completely given up for a good amount of time now looking at stocks that have fallen a lot. In fact, my entire watch list is comprised of stocks that are near 52-week high or all-time high level. That's it. It serves you two purposes. Number one, you're going with the trend, right? If a stock is at 52-week high or all-time high, that means that the stock is performing well. So you are aligning in the direction of trend. And number two, when you're going behind stocks that are at 52-week high and lifetime high, the left side of the chart does not have a lot of resistance. What I mean, so let's say I'm buying a stock here that is breaking out. There is no price action activity here. So price can move higher with a lot of momentum. This is an example of Nifty Bank. Someday I'll show you with the stock, or maybe in the slide itself. So this is a chart of KPIT Technologies. Again, something that I picked up a couple of months back. Now you look at KPIT Technologies, what it is doing. It formed another base in the week of May, that is at 950. The first base that KPIT was forming this year was in the month of March, when it was breaking out here in 2023, just in the last week of Feb. It virtually went nowhere. It just consolidated because back then IT index was not doing well, and then again you got this confirmation candle right at 50 DMA. So what is technically happening here? At this point the price is at 909. Where was the 52-week low? It was at roughly 450, which means the stock is up 100% before it gives a confirmation, and 120% before you can start scaling into the stock. Are you getting the point here? If you do not incorporate this particular teaching about including stocks that are forming sound bases and breaking out into all-time high level and then going behind those stocks, then let me tell you, you'll be missing out on a lot of opportunities. It's a tendency for traders and investors to avoid such stocks that are breaking out into all-time high because it already seems too high. But what is high in stock market in the right cycle, it keeps going higher till the time the broader market trend remains strong. As soon as the broader market trend starts to change, that is when the stock starts running into trouble. So KPIT was another beautiful example. It's up. You can check a lot of stocks that I had shared. All are combination of 52-week high level, all are combination of all-time high level, and stocks breaking out with good wide range candles on the upside. The next rule, it's actually 2 points that I wanted to combine. Not following your buy and sell rules causing you to make an increased number of mistakes. The soundest rules you create are of no help if you don't develop the strict discipline to make decisions and act accordingly to your historically proven rules and game plan. I'll explain that. Let me just complete this also. The next part is concentrating your effort on what to buy, and once your buy decision is made, not understanding when or under what conditions the stock must be sold. So I'll take up this particular rule. See, there are a lot of traders in the market. When you talk to your friends or maybe relatives who are into trading, they'll tell you that one day they are following something like a Davos box system, next day they are into point and figure, then they are into Stan Weinstein, then they are into Mark Minervini and those kind of things. There are two problems here. Number one, I'm sure that person does not have a well documented, printed out trading plan on his desk. And number two, he has not studied the historical results of that technique. See, why trading is so difficult, I'll tell you. It's difficult because there are no barriers of entry here. What is barrier of entry? To become a trader, there is no qualification that is required. There's no work that you need to do beforehand. You just got to click KYC, Aadhaar done, a Demat account is open, trading account is open, you transfer the funds and tomorrow you're a trader. So there is no process that a person has to go through to become a trader in the market. It is so simple. Technology has made it so simple, and then you start making really poor decisions in the market. So the next time you hear that your relatives or your associates are not doing well in the market, probably it's not the mistake of the market. It could be that one of these reasons are the root cause of everything in the market. And let me tell you one thing: you can have my system to trade with, or the system of any other trader or investor you follow, and still you will not be able to get the similar returns, because discipline is the underlying reason of success for most of the people in the market. If you're not disciplined, then that money is simply going to go away. The next part was about concentrating your effort on what to buy and under what conditions stocks should be sold. I'll give you one example. So this is a example of Anantraj. Again, this was one company that I picked up 120% from its lows in 2022. So this is where I started buying it, and 50% from the nearest pivot point. So now the stock is at 155. That is from 125. It has gone to 155. Now what this rule is all about, that is under what conditions the stock must be sold. So what I do as a trader is that whichever stock I'm holding, whether it is in my trading portfolio or whether it's in my investment portfolio also, I review those stocks every single weekend. That is on a Sunday or a Saturday. I take the list of my holdings and I go through each of the chart of those stocks just to mark out where are the nearest pivot points. So for example, in Anantraj, if I find this stock violating the 132, 133 pivot on a closing basis, I'll simply cut out all my positions, because that is not what the stock is supposed to do. So what is this? This is me having a plan and the conditions under which I will sell the stock. So this is nothing but actually weekly homework that everybody has to do in the stock market. And I can tell you this, that 9 out of 10 people you talk to in the stock market do not do homeworks. This is a habit that we have cultivated from our school life, especially people who are between 20 to 50. When we were given homework, I don't think a lot of us used to do that homework. we used to be busy doing a lot of other things. Then next morning we used to rush to school, pick out the person who was the brightest in the school, take his notebook and copy everything down. At least that is what I used to do. I used to see a lot of people doing that also. Nowadays it is different. Nowadays everybody is doing homework, because it is actually not the students doing it, it is the parents who complete that homework. But I hope you get the point. Stock market is all about homework. The most successful people in stock market are the ones who will do a lot of homework. And homework means going through charts, marking out pivot levels, looking at the market breadth data, looking at the global market data, studying your portfolio. There was a YouTube shorts I did yesterday where I was specifying this, that your portfolio is your biggest indicator. Always have your portfolio in front of you. Do analysis of it, how much it is falling, which are the stocks which are going up, which are the sub industries within your portfolio that are moving up. That kind of data is invaluable. It will give you, it is actually much more important than any indicator you see on these videos and you're reading about those indicators on social media. So your portfolio is your biggest indicator. Your portfolio combined with homework is next to holy grail that you'll get in the market. See, many times I'm getting an email that this is what I'm doing, can you help me out? That is what I'm doing, can you help me out? My account is down 10%, can you do something about it? There is only one thing I write back, that can you show me the logic based on which you are picking out the stocks? Can you show me your homework that you have done? I never get a reply. So stock market success, in one word, if I can tell you, is all about the amount of homework you do and combine that with consistency. That is, in other words, discipline. The last rule that actually saved me a lot in initial years, at least helping me not blowing up accounts, not going into debt, speculating too heavily in options or futures because you see them as a way to get rich quick. By the way, I'm not against futures trading at all. I'm not against buying options also, because there you can calculate your net risk. And at least buying options, the premium that you pay is the maximum amount you can lose. Futures, you got to be a little careful. Some investors also focus mainly on shorter term, lower priced options that involve greater volatility and risk. The limited time period works against holders of short term options. Some people also write naked options, that is selling options on stock they do not even own, which amounts to taking greater risk for a potentially small reward. Now, I will not repeat my thoughts about writing options. It is something I've repeated in many videos. But if you are a poor student of math, that is when you will risk 100 rupees to get 10 rupees in return. Or in other words, you will risk 50,000 to get 20,000 in return. So that is basically being a poor student of maths. There are some genuinely good option sellers, and my comment is not for them. But you and I are not in that league. All right. The sooner you realize this, if it was so easy, if writing options and generating income, if writing options and making a living was so easy, then why do institutional desks exist who deal in equities, who deal in futures or other instruments? Why not everybody just quit their job and start writing options? See, there is again, if you backtest it, you will know there are specific periods in the market where option writing backfires big time, and it takes away the last 7-8 months of profit in one day. So I won't repeat that, it is completely up to you. But this was also one of the key rules that actually helped me sustain in the market. That is, I'm an active futures trader, by the way. I also take massive leverage in futures. Let me be very open about it. It is just that I don't openly discuss all that, because everybody's experience level is different, and I don't want to influence anybody in a negative way when it comes to participation in the market. I personally feel and I truly believe that equities is the greatest asset in the whole world. There is no other asset that will help you own a company that becomes 10x, 20x, 25x or pays you such rich dividends, bonus splits. Nothing in this world can match equities. That is what I believe. That is what I strongly encourage. And I also actively teach trading, but only in equities. I do teach futures trading a lot, but only index futures, because there relatively you can manage the risk out. So these are these 3 books that I've put out in front of you. More importantly, the one book that is How to Make Money in Stocks, and just Google William O'Neill, all books you will get. There is no other book apart from this and the book by Stan Weinstein, and later on obviously Mark Minervini's work, that you'll require to become a trader who knows how to protect his losses. Now that is what I'm always bothered about. If you learn how to protect your losses, you will start doing really well. On a batting wicket, if you learn how to protect your wicket or not get out, you'll automatically start scoring runs. It is not that difficult, and it is just something experience teaches you. And of course, the likes of William O'Neill, who have inspired so many people all over the world. More importantly, being open about sharing knowledge. Now there are a lot of amazing investors who are there in this world today. Take for example Warren Buffett, Charlie Munger, and there are many traders. I mean, Paul Tudor Jones. The list is endless. But the reason why I rate William O'Neill above all of these names that I've taken is because I think he was the only one who was very open about passing on that information to the next generation, because I think that is the most important thing. Knowledge is not to be taken to the grave. Knowledge is your knowledge will also grow exponentially if you share it. I mean, the amount of things you will learn just by putting out your thoughts out there and not worrying about any negative feedback, because that is part and parcel of life. But you'll impact a lot of people positively if you begin sharing your knowledge. You'll make a lot of mistakes. Sometimes you'll say things that are not relevant. Sometimes you'll put out information that in hindsight you will see that was not entirely accurate. These things happen. But knowledge and what you learn does not have any meaning if you don't pass it on. So that is what William O'Neill also believed, and that is why I always will be thankful to him and rate him as high as anybody who ever lived in the field of stock market and did so much for the community. So have a great weekend ahead, guys. Take care. And